Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
Following a sharp downward move on the yield curve since the beginning of the year, we expect that in the fourth quarter the Polish sovereign curve will further shift slightly downwards. In our forecasts, we assume that 2-year, 5-year and 10-year bonds will finish the quarter around 0.05%, 0.55% and 1.25% respectively. Following a significant monetary policy easing since the start of the pandemic, the Monetary Policy Council is unlikely to propose further rate cuts in Poland. The NBP will, however, remain active in its bond purchases on the secondary market, keeping policy loose. Despite high spending to finance anti-crisis measures, bond issuance in the fourth quarter in Poland should remain low. This will be slightly counterbalanced by the issuance coming from state agencies. However, the entire demand from investors is unlikely to be satisfied. The increased number of coronavirus infections at the beginning of autumn is weighing on market moods, keeping demand for safe haven assets steady. The reintroduction of virus-related restrictions and lockdowns may call for further stimulus coming from both governments and central banks. With the policy rate slashed to near zero, the members of the Polish Monetary Policy Council are hesitant to consider negative rates. Such a scenario is also priced in by the money market, with rates expected to not be raised within the next 2 years. The rate-setting body is still worried over the possibility of inflation falling below target in the medium term. Thus, despite the CPI holding above the 2.5% target in recent months, the calls for rate hikes are swiftly rebuked. Although in recent months the pace of asset purchases by the NBP has significantly slowed down, it is still providing support for Polish government bonds. The bond buying program in Poland is the largest comparing to regional peers. The dovish stance in monetary policy should anchor the short end of the yield curve close to zero. According to the revised 2020 bill and draft for 2021, the borrowing needs and budget deficit are surging. Following a strong increase in Polish marketable debt outstanding in the first half of the year, in the second part it is holding steady as the Ministry of Finance is holding predominantly switching auctions. The authorities have already financed nearly 100% of the revised 2020 needs and still enjoy an elevated liquidity cushion and are hesitant to issue new debt. The effect of low supply of government bonds is partially mitigated by the sale of state guaranteed securities by the State Development Bank and State Development Fund. Those agencies, however, have scaled down their original plans of 100 billion zloty issuance each. The tender results are showing a recent strong demand for their bonds, which cannot be fulfilled at government auctions and should further support a decrease in longer-dated yields. The rising number of COVID-19 infections at the beginning of autumn has led some governments, especially in Europe, to tighten pandemic-related restrictions. Poland reclassified the so-called green zones into yellow zones, which translates to limitations of social gatherings, increase in social distancing in public space, as well as compulsory wearing of face masks. Although the impact of new restrictions is unlikely to be as significant as in the second quarter, the GDP in fourth quarter is likely again to be negative in quarter-on-quarter terms. Our house economists expect the 2020 GDP to shrink by 2.9%. With restrictions being reimposed elsewhere, the calls for further stimulus are likely to support safe havens. Further monetary policy losing in the euro area is expected as inflation turned negative. The comprehensive US fiscal package is stalled, however, an outcome is expected after the November presidential elections. This leads us to expect that in the fourth quarter the spread on 10-year Polish bonds versus the US and Germany to come at 55 basis points and 175 basis points respectively.